Kia ora, and welcome to Tuesday's Economy Watch, where we follow the economic events and trends that affect New Zealand. I'm David Chaston, and this is the international edition from interest.co.nz, and today we lead with news: chaos has consequences, but they seem to be coming faster than many thought. The giant US economy is resilient, but not immune to the consequences of misguided policy decisions. Regular listeners will know we regularly track the Atlanta Fed's GDP Now signals. Today, that has suddenly shifted from expecting a 3% expansion in the first quarter of 2025, with the data on hand at the start of February, to a sharp 2.8% contraction as the latest data comes in for the US economy. We have been noting the slide in the granular data over the past week or so in these reports. Today there was another from the ISM PMI for February. Specifically, new orders in their factory sector took a sharp turn into contraction, as they report demand is weakening fast. The overall PMI rose in this report, but due to production and inventories. Shrinking new order levels are not going to be sustaining that, however. It was a different story for the internationally benchmarked S&P Market US Factory PMI, which is still reporting an expansion, and a good one. But this one isn't supported by the wider series of data over the past few weeks of weak new order levels, rising inventories, and an imbalance between household spending and disposable incomes. The Atlanta Fed is signaling these are turning the US growth into reverse. We won't actually know for some weeks yet, of course, but it seems the Biden prosperity has been turned into a Trump-Musk contraction. And more uncertainty is on the way. Congress has less than 2 weeks to extend a federal funding deadline, but lawmakers are arguing over whether the Whitehouse will really spend the money they approve. The February Canadian PMI turned suddenly -2 in response to the tariff war outlook. Later today, the US is expected to impose the threatened tariffs, even though they earlier promised to delay them to the start of April. Consistency and promises are loose ideas in today's White House. There are a wide set of early factory PMIs in a number of Asian economies, and they all showed very little change, and only minor variations around an expansion-contraction fulcrum. This includes reports for Japan, Malaysia, Thailand, Vietnam, and Taiwan. The tariff war impact are yet to be hit here. In fact, Indonesia was a bit of an outlier, recording a very good rise, but it enabled the overall ASEAN group to record a good rise. India's PMI signalled a mild slowdown from their fast expansion rate, and Singapore's PMI recorded a minor expansion in February. And the official China factory PMI came in at 50.2, an improvement for February from January's contraction. This was backed up by the independent Caixin factory PMI, which came in with a slightly faster expansion in its survey. This is consistent with the US import data for January, which suggests the US import data will be very high again in February. In Europe, their inflation rate eased to 2.4% in February, down from a 6-month high of 2.5% in January, but slightly above market expectations of 2.3%. But there is a wide range, from 1.4% in democratic Denmark to 5.7% in autocratic Hungary. For the EU overall, it was running at 2.8%, for the euro area 2.4%. Europe's overall PMI is still contracting, but the drivers of their contraction eased somewhat in February. In something of a surprise, the Melbourne Institute tracking of inflation and cost of living in Australia reported a 0.2% drop in February from the prior month, after a 0.1% rise in January. Most thought a rise was on the cards, but on an annual basis, inflation there is still running in the 2 to 3% range. Also turning negative in February from January was the job ad series from ANZ Indeed. It was down 1.4% from January, but at least it wasn't down the 6.9% it was in February 2024 from January 2024. And CoreLogic is reporting that the Aussie housing market stabilised in February, with small but consistent house price rises in the month in almost all the main centres, rolling back some of the quarterly and annual falls in some of their larger cities. The one RBA rate cut is getting the credit for the sentiment improvement. And by the way, it seems the expectation for an Australian election is narrowing to an early event, maybe on April the 12th. In the face of US missteps, policymakers from Canada to China are readying plans for a global downturn, and high on their agendas are looser fiscal and monetary policies to insulate their people from the worst effects. The US is also moving to much looser fiscal policies with large tax cuts for the wealthy and likely ballooning deficits. We're entering the area of huge distortions, and it is unlikely to be pretty. Today, the US Treasury 10-year yield is at 4.18% and down 2 basis points from yesterday. And the price of gold will start today at just under $2,892 an ounce, up $35 from yesterday. And oil prices are down 50 US cents at just on $69.50 a barrel in the US, while the international Brent price just over $72.50 a barrel. Lower expected demand is why this price is soft. The Kiwi dollar is now at 56.3 US cents and up 40 basis points from yesterday as the US dollar comes under pressure. Against the Aussie, however, we're still a little changed at 90.2 Australian cents. Against the euro, we're down 30 basis points at 56.3 euro cents. That all means our trade-weighted index stars today are just on 66.2, essentially unchanged from yesterday. And the Bitcoin price started today at $90,059 and down a net 1.5% from this time yesterday. Volatility over the past 24 hours has remained high at plus or minus 3%. You can find links to the articles mentioned today in our show notes, and you can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again tomorrow.